A massive shift in Arctic defense is quietly pulling space infrastructure closer to Earth, and one small-cap company sits right at the intersection of that change. Redwire Corporation, ticker RDW, is trading around $10 per share as of early 2026. Though prices can change, and in this video we're breaking down what the company actually does. Why some investors see upside tied to defense and very low Earth orbit. Where the risks are, and what kind of investor this setup might appeal to. Quick reminder before we go any further, I'm not your financial advisor. This video is for educational and informational purposes only and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money. So always do your own research or talk to a licensed professional before making any decisions. At its core, Redwire is a space and defense technology company that sells critical hardware, platforms, and engineering services to government agencies and commercial customers. Think of it less as a consumer-facing space brand and more as a supplier of the underlying infrastructure that makes modern space missions possible. Its customers aren't buying hype, they're buying reliability, qualification, and flight heritage. The company's offerings span satellite platforms, power generation systems like solar arrays, optical sensors, docking and berthing mechanisms, and in-space research hardware. These aren't one-off science projects. In many cases, they're repeatable components that get reused across multiple government and commercial missions. Over the past year, Redwire reorganized its operations into two main segments: space and defense tech. The space segment covers spacecraft platforms, in-space manufacturing, and power systems. Defense tech focuses on autonomous systems, intelligence and surveillance tools, and digital engineering environments used by military customers. That split matters because it lines up directly with how defense budgets are actually being allocated: persistent sensing, autonomy, and resilient infrastructure. One of the most important technical themes driving interest in Redwire is very low Earth orbit, or VLEO. This refers to satellites operating well below traditional low Earth orbit, roughly under 300 kilometers above Earth. At those altitudes, spacecraft fly much closer to the planet's surface. That proximity improves image resolution, reduces latency, and can materially enhance intelligence, surveillance, and reconnaissance missions. Redwire has invested heavily in platforms designed specifically for this environment. Its SabreSat and Phantom spacecraft are engineered to survive and operate in higher drag conditions using electric propulsion and aerodynamic optimization. In simple terms, they're built to skim the atmosphere without burning up or losing control. For defense and security missions, that closeness matters. A sensor operating at half the altitude can achieve similar resolution with smaller optics, which reduces cost, mass, and launch complexity. That's why VLEO is increasingly discussed as a layer for missile tracking, Arctic domain awareness, and time-sensitive intelligence. This ties directly into the broader geopolitical backdrop. Governments are placing renewed emphasis on missile defense, hypersonic threat detection, and persistent monitoring of strategic regions like the Arctic. Long-duration defense initiatives tend to favor suppliers that already have qualified hardware, security clearances, and a track record of execution. Redwire checks many of those boxes. From a bull case perspective, one of the strongest arguments is Redwire's role as a picks and shovels provider. Rather than betting on a single constellation or flagship satellite, the company supplies components and platforms that can be used across many missions and customers. That diversification can smooth revenue over time if space and defense spending continues to expand. Another bullish factor is scale and backlog momentum. By late 2025, Redwire was operating at an annualized revenue run rate north of $300 million, with quarterly revenue growth exceeding 50% year-over-year at points during the year. Management has also pointed to backlog of roughly $350 million and improving book-to-bill ratios, suggesting customers are placing new orders faster than revenue is being recognized. A third bull argument is multi-domain integration. In mid-2025, Redwire acquired Edge Autonomy, bringing in combat-proven unmanned aerial systems already used by the U.S. military and NATO allies. This wasn't a random acquisition, it expanded Redwire beyond space into airborne intelligence and reconnaissance. From a defense customer's point of view, the ability to integrate satellites, drones, and ground systems into a single operational picture is increasingly valuable. There's also longer-term optionality that doesn't show up cleanly in near-term financials. Redwire is a leading commercial operator of microgravity research hardware on the International Space Station. Pharmaceutical companies and research institutions use its systems to run experiments that are difficult or impossible on Earth. While this segment is still relatively small, supporters see it as an early position in future space-based manufacturing markets. On paper, that combination of defense exposure, space infrastructure, and optionality looks powerful, but that's only one side of the story. If you're getting value from this breakdown, tap like and subscribe to Penny Stock Pulse. It really helps the channel and tells me to keep making these deep dives for you. The bear case starts with profitability. Despite strong revenue growth, Redwire has struggled to generate consistent earnings. In 2025, the company reported sizable net losses, driven largely by cost overruns on complex, fixed-price contracts. When labor, materials, or timelines don't go exactly as planned, estimate TAC completion adjustments can hit margins hard. Execution risk is tightly linked to this issue. Many of Redwire's programs involve first-of-kind or early-generation technology operating in extreme environments. Delays, redesigns, or qualification issues can quickly turn a profitable contract into a loss. Management has said operational discipline improved later in 2025. But investors are still being asked to trust that these problems are now contained. Another major risk is the balance sheet and dilution. The Edge Autonomy acquisition significantly increased Redwire's scale, but it also brought additional debt and share issuance. On top of that, large early investors have been steadily reducing their positions, increasing the public float. While that can improve liquidity over time, it can also create sustained selling pressure in the near term. Valuation is another consideration. Even after pulling back from prior highs, Redwire trades at a multiple that assumes continued growth and improving margins. If defense spending priorities shift, if contract wins are delayed, or if margins fail to recover, the stock could reprice lower to reflect a more conservative outlook. From a chart and sentiment perspective, the stock has been volatile. It surged sharply into early 2026, then pulled back as profit-taking and block selling emerged. Some traders focus on the $10 to $11 area as a congestion zone, with resistance overhead and prior support below. This price action reinforces that RDW behaves like a high-beta, news-driven name rather than a stable compounder. So who might this be for? Redwire may appeal to investors who are comfortable with small-cap volatility and who think in multi-year time frames. The thesis requires believing that defense and space spending remains structurally elevated, that VLEO becomes a meaningful operational layer, and that management can translate revenue growth into sustainable margins. It's far less suitable for those seeking near-term income or low-risk exposure. To recap, the bull case rests on Redwire's positioning in space infrastructure, very low Earth orbit platforms, and integrated defense systems at a time of rising geopolitical demand. The bear case centers on profitability, execution risk, dilution, and valuation sensitivity. The next year will likely hinge on margin trends, contract performance, and clarity around long-term defense programs. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next under-the-radar breakdown. Thanks for watching, and I'll see you in the next video.